can we back off our retirement income contributions and still be okay? This is a question that came in recently. I think it's a good question. It came from a younger federal employee, 36 years old, 3 kids, married, and kind of dealing with trying to balance lifestyle goals versus, those future retirement goals. And I think this comes up more than we think. They've been really disciplined over the last few years, contributing to the TSP, building some savings, as well as just building some home equity on the balance sheet. So a lot of good things going on. And now kind of wondering, we'd like to take some of these adventures, have some of these experiences while the kids are young. Hopefully they're going to remember it. We can all do it together, because really that's what this is all about, right? It's creating stability and security so we can do the things we love with the people that we love. All right. So I want to look at this from a retirement planning standpoint and show you kind of what the projections look like if you back off a little bit, but coming from the angle of federal employee, of course, and guaranteed income benefits, how those play into the equation. So a lot of good information. I'm going to walk through a little case study here with you in the video. So let's go ahead and dig into it. Okay, so as I mentioned, 36-year-old federal employee. We're going to call him Sam Sample and Samantha Sample, right? Of course, we've changed the names. But this is a federal employee who had some previous military experience. They're targeting MRA plus 30 at age 58. So MRA is 57. They'll hit their 30 years of service with some military buyback when they turn 58. So that's really the big goal here. Both spouses are the same age. I'll just show you the goals here. So we're targeting 58 as our retirement age. And retirement expense is kind of a work in progress. We were throwing around a couple different numbers, but I think $7,000 to $8,000 is kind of where we're thinking. Although, we're talking 22 years out. If we go from age 36 to age 58, that's a pretty long period of time. A lot of things are going to change in this plan. We always say in financial planning, there's going to be adjustments. We're going to have to change the plan in some way or another, because a lot of these things are straight line projections. Life doesn't move in a straight line. The markets don't. Your financial plan doesn't. So a lot of changes. Long story short, we're going to work on this retirement expense thing, not to put too much stock in that in the course of our projections here today, because ultimately what we want to get to is the impact of reducing those retirement contributions. But let's look at their current income. So he's on the GS pay scale. Right around $125,000 a year is his current salary. Also has some VA disability coming in. So that's about $48,000 a year, which is tax-free income, that's going to be on the cash flow statement going forward into retirement. And then of course, if we're looking forward, we're going to have Social Security for both spouses. Samantha is currently not working. And so her Social Security benefit, if this holds up, will just be, the spousal benefit based on Sam's track record, his earnings history. Okay. And then of course, as we mentioned, he's a federal employee. So there's going to be a FERS pension. I did some preliminary numbers. I took $125,000. I didn't assume any promotions or greater step increases. And I kind of ran that out with a 2% pay raise 22 years from now. Give us a high 3 of around $185,000. Okay. Whether it's a high 3 or high 5 at that point, it's probably going to be a high 5 or something completely different, but we'll adjust when that time comes. But for the sake of this, that gave me $185,000 times 30 years times 1% multiplier, a FERS annuity of right around $55,000. I took some reductions for the survivor benefit, which we know is going to be important with Samantha being the spouse here. We're going to be talking about FEHB coming off of that, which is really a bit of guesswork. I just estimated $6,000 coming off that. So between those two reductions, that brought me down to this $43,950 mark. That's kind of where I got that at age 58, which we know will hold steady at 58 until we hit 62, and then cost of living adjustments will kick in. So that's kind of what the income setup looks like now. And of course, when we hit retirement age, Social Security, will we take that at 62 or later? That's, we're going to get into that a little bit. Okay, balance sheet, as I mentioned. So they've got some money in a TSP, and they've been diligent about this over the last few years, kind of building this thing, making maximum contributions to Sam's TSP. That's been their focus, as well as building some long-term savings. And they also have some home equity on the balance sheet. Okay, I didn't put that on here. I didn't put the mortgage in because the plan is for that to be paid off in 10 to 15 years. And we're just not going to incorporate that into the retirement planning just yet. I want to just look at what we're doing with the guaranteed income sources that I mentioned, as well as this investment portfolio. There's some tax diversification issues here that we need to discuss. Of course, if all the money's going into just the traditional TSP, that's not setting us up to be very efficient in the future, but that's also a topic that's probably a separate video, right? That's a little bit about the balance sheet. So let's jump over to our retirement income planning module and just kind of take a look, get the lay of the land here. So what I'm going to do is look at our inputs. Okay. So of course we talked about the 58 being the retirement age. We talked about the retirement expenses on a monthly basis, bit of guesswork there, current salary, and then Sam's TSP. Now on the current plan, I have him maxing that out. In the proposed plan, we're going to look at making some adjustments. So maybe a 50% contribution. What does that do to the total balance 22 years down the road, or somewhere somewhere in between, since that is pretty extended period of time. Usually we're looking at this thing 5 to 10 years out as we're making plans to transition into retirement. This is a little bit longer of a timeline that we're considering here. Okay, and then just on the plan here, we're going to say Social Security at age 62, look at taking it at that point. Again, that's a bigger conversation, whether that's the right age or not. We've got time to figure that out. Okay, so that's our inputs. And what I want to do is jump over to my cash flow table and show you kind of what things look like from an income perspective. And then I'm keeping you waiting for this. I mean, we were talking about how do the accounts project really being the focal point of this if you take your foot off the gas. But so here's my cash flow table. I got inflows on the left side. I got outflows on the right. So it basically means income versus expenses. How do things match up? And you can see here, this is current. So we've got salary plus the VA disability coming in. So I'm going to scroll down to age 58, which is our retirement age, and kind of take a look at things. All right. So first, let's look at the income flows. So you can see a salary drops off here. The VA disability pension continues. So that's going to be indexed for inflation. I have 2% on that. So that continues to increase over the next 22 years. So that's kind of what we're looking at from that standpoint. And then you can see here it jumps up because the first pension kicks in. So, here's the numbers, right? So the first pension, 43,950, we talked about after the survivor benefit reduction and FEHB, whether that's accurate or not. Maybe this number is something a little bit different, and then the VA disability coming in on top of that. And then we got our cost of living adjustments here in the second column that are going to start at age 62. So you can kind of see how that all flows together. So that gives them, pension income coming in of $121,000. What does that translate in today's dollars? That's probably somewhere closer to $60,000 to $70,000. I could run the present value projection, but I'm just kind of guessing there. So, and we can kind of compare that to get an idea here when we look at expenses in this column. So at 58, I mentioned we had the living expenses that I put in at $8,000 a month. So, that's $96,000 in today's dollars. And you run that out at 22 years times our inflation adjustments, what's right around 3%, that bumps up to $178,000. Okay, so it doesn't quite double, but almost gets there. So you can see kind of how those present value to future value adjustments look here with, depending on what your discount rate is. So those are kind of our expenses. As I mentioned, the mortgage would drop off. Whether $8,000 in today's dollars is the right number or not, it's something we're gonna have to look at. And then of course, we're gonna bring taxes in and you can see what the tax footprint looks like. The pension income is gonna be fully taxable, VA disability. Well, pension income is gonna be probably 90 to 95% taxable. Depends on what happens here with your contribution rates as those things continue to increase. And then, the exclusion ratio that comes back to you, the return of your principal in that payment. We'll also have Social Security being taxable when that kicks in at 62, investment income, depending on how they structure this. He's probably a good candidate for Roth because based on the income right now, the majority of their money is going to fall into the 12% tax bracket. There's going to be a little bit maybe at the top end that falls into 22%. So he's probably a really good candidate to start filling the Roth bucket, I think, unless something changes with their income situation. And one thing I will, just going back to the first pension, I didn't build in any promotion grade step increases. That was just, keeping the current salary now, just getting pay raises. All right. So that's kind of, if that changes, then the numbers look different as well. Okay. So that's kind of what we're looking at. And you can see there is a negative cash flow here when they retire. So there's a gap to make up. That gap gets smaller when we hit Social Security age of 62 and you start taking those benefits. What do the investments look like? According to our home screen, of course, the probability of success on this plan is pretty good. Okay, so obviously those numbers look pretty good. And if straight line projections again, so I want to be cautious with this because the plan is so far out into the future. Our projections are really looking at what happens if you make 8.5% a year every year. We know that's probably not going to be the reality. Making up the delta here, and then it gets much smaller as Social Security kicks in. So, that's not too big of a number to make up from your investment portfolio. So let's take a look at it. I'm keeping you waiting here throughout the video for this part of it. But if we look at accounts, and we kept this simple, we didn't build any tax diversification or anything into this plan just yet, but we certainly can. This is kind of how things are projecting. So, the starting balance next year with contributions. So I want to look at the current plan. So, all right. So if I look at the current plan, this is with maxing out, of course, agency contributions, that the match plus agency matching contributions gets us up to 5% plus the maximum contribution from the employee. This is kind of what it looks like. So if we scroll down to age 58, you can see $3.2 million in assets. So it's a great portfolio. We adjust that back to today's dollars. What does that equal? Again, it's probably somewhere between 1 to 1.5 million, depending on what your discount rate is for inflation. Okay. So it's somewhere in that ballpark of today's dollars. All right. So it's a good portfolio. Now, in the assumptions that I showed you on the scenario page, the homepage there for the retirement planning module, I said we were going to contribute half. So we we're going to make a contribution of $11,750 a year versus 23,000. And you can see how the numbers change here. So same thing here. Now we went from over that portfolio that was up over 3 million down to 2.1. So about a little over $1 million in portfolio value is the difference here. Okay. What does that mean in terms of annual income? If you apply the 4% rule, $1 million is worth $40,000 a year. Okay, if you take a higher distribution, maybe it could be worth 50. So that's kind of what you're looking at. Now, of course, do they have to reduce their contributions for that entire time period? The kids are going to get older. They're going to be on their own at some point within the next 22 years right there. So maybe there's an opportunity to pause these contributions for 5 to 10 years, come back to it and start contributing higher amounts. That's completely on the table, and that would change these numbers as well. It would skew them a little bit higher, of course, with more contributions. I just want to reiterate, these are straight line projections, of course. We know life does not move in a straight line. So take that with caution when you do this. It gives us a good fundamental kind of baseline to work off of, but just something you need to be aware of. That's kind of what the accounts look like. The other part of it was Social Security. If you're looking to track down your Social Security estimates, go to ssa.gov and you can get your current numbers pretty easily there if you create an account. If you don't want to, you can use a quick calculator, which is what I did for this case. I plugged in $125,000 at current age 36, and it gave me the estimate, a little over $6,000 a month in future dollars, which translates back to $2,500 in today's dollars at age 62, which is a pretty good benefit on the scale of Social Security benefits. Okay, so that kind of answers, it takes a look at the question anyway. It doesn't answer the question, of course, as I mentioned. That's a long timeline that you're going to have to plan for, but it gives you some perspective on how the numbers might change so you can continue to play around with it. If you're working through a scenario like this, I would encourage you to actually run your numbers to see what happens if you take a pause for 5 to 10 years versus the entire period, because those numbers will look a bit different, and then you can kind of work on what you might want to do. There's other issues to address in this financial plan, okay? Estate planning, insurance coverage, tax diversification, education plan. We got kids in the mix here, right, that we probably want to plan for. So all those things is something they need to take a look at. With the spouse not working, the estate planning and the insurance coverage are pretty important. So it's something they're going to want to button up if they haven't done so already or have plans to do so. Can you do this? Can you back off your retirement contributions? Yes, you probably can. You could probably make this work. The numbers look pretty good for them based on those guaranteed income sources, having the VA disability plus the FERS pension. If their federal career holds up over the next 22 years, benefits don't change too significantly. One thing I didn't mention is I didn't put the special retirement supplement in just because of all the uncertainty around that right now. That's something that also would kind of help them bridge that gap between 58 to 62 if it's still around at that point. So what's the right answer here? Of course, the more work you do now, the more contributions you make, makes it a little easier in the future, right? If you're doing the heavy lifting up front, it really translates because of the power of compound interest and just how, the balances will grow based on those concepts. And, with $175,000 in their investment portfolio, it's a good foundation, but I don't think they've quite hit those big numbers yet where things start getting easy. Like even maybe targeting $250,000, $300,000 in portfolio value, because now you start continuing to work with larger numbers. Your return, if it's the same percentage, but it's on a larger portfolio, obviously it's a greater amount going back into your portfolio based on that compound interest year after year. So when you kind of hit that tipping point of $300,000, $400,000, $500,000, those are the bigger numbers. Maybe it makes more sense to hold off until you get to that point. I don't know. You got to create some balance here, because I am all for creating the experiences, going on the adventures while you can. Like I mentioned, that's what this is all about. So just wanted to give you, a little bit of insight, kind of look at that question, because I think it's an interesting one that probably a lot of folks consider. Okay. And you can apply this, if you're a younger federal employee, even if you're in your 50s and you're kind of counting down the last 5 to 10 years. I know there's so much uncertainty right now, but you can run the numbers and kind of see where you are. That's really the name of the game to making these smart financial decisions. So hope you found some value here. If you have, please give us a like and subscribe. If you have questions, if you're working on something, we'd love to hear from you. I'd love to hear what you're working on and be a resource. Remember, with all these big decisions, you don't have to make them alone. All right. So feel free to reach out, and would love to hear from you. So we'll see you next time.